Welcome to another video, guys. In today's video, we will be speaking about investing over saving. When it comes to growing your wealth, there's a significant difference between saving and investing. Both have their place in personal finance, but if your goal is to build long-term wealth, investing is often the smarter choice. While saving is about putting aside money for short-term goals or emergency, is about putting your money to work over time, allowing it to grow at a rate that outpaces inflation and provides you with a potential for higher returns. Let's explore why investing over saving can help you build wealth in a long run. Key difference between saving and investing. Saving. The goal of saving is usually to preserve your money for short-term goals like emergency fund or down payment for a house or a vacation. It's often done in low risk option like a savings account or a certificate of deposit. Investing. The goal of investing is to grow your wealth over time for long-term goals, such as retirement, education funds, or building generational wealth. It involves putting your money into assets like stocks, bonds, real estate, trading, or even commodities like gold. Saving typically involves minimal risk, therefore provides minimal returns. For example, a traditional saving account would offer a little interest return of below 1% a year. Investing, on the other hand, involves taking more risk in exchange for potential higher returns. For instance, the stock market historical returns about 7 to 10% per year on average, while assets like XAUSD or real estate can appreciate significantly over time. With savings, your money grows slowly. Due to inflation, the purchase power of your saved money decreases over time unless it's earning a return. Investing, on the other hand, has a potential of compounding. This means that your returns earn returns. Over time, this compounding effect can significantly increase the value of your investment, especially if you invest consistently. Saving, one of the biggest drawbacks of saving is inflation. Even though your money is safe in saving account, it often loses value due to inflation. For example, if inflation is 3% per year, your saving account only offers 1% interest rate, your money is effectively losing purchasing power. Investing helps you beat inflation while it's risk-free. While it's not risk-free, investments like stock, bonds, and even real estate have a potential to grow faster than inflation, preserving or increasing your purchasing power. Why investing is better for building wealth. Higher returns. If you want your money to grow at a rate that outpaces inflation, you need to invest in assets that can deliver high returns. Stocks have historically offered some of the best long-term returns, averaging about 7 to 10% a year. XAUSD, for instance, has historically been used as a store of value and often performs well during times of economic uncertainty. Number two, compound interest. One of the most powerful tools for growing wealth is compound interest. With investments, the return you earn are reinvested and generate more returns. Over time, this compounding can result in sustainable growth. The earlier you start investing, the more you can benefit from compounding. Financial independence. The goal of investing is often to reach financial independence, where your investments generate enough income for you to live on without needing to work. By investing in income generating assets, your wealth grows and you have the opportunity to build passive income streams. Diversification. Investing allows you to diversify your portfolio, spreading risk across different assets classes such as stocks, real estate, gold, and bonds. Diversification reduces the risk of putting all your eggs in one basket and ensures that your money is working for you in multiple areas. Retirement savings. If you want to retire comfortably, saving alone likely won't be enough. Investing in retirement across various platforms allows you to grow your money over decades and build a nest egg for retirement. Saving versus investing for different goals. Short-term goals. For short-term goals like emergency funds, saving is important. You need to have cash readily available without the risk of market fluctuation. Money market accounts, high yield saving accounts, and certificates of deposit can be ideal for this. Long-term goals. For long-term goals like retirement or buying a home in 10 years, investing is crucial. Stocks, mutual funds, real estate offer much better return and trading as well. How to get access with investing. Start early. The earlier you start investing, the more time your money has to grow. Begin by setting aside a portion of your income regularly to invest, even if it's small amount at first. Diversify. Spread your investments across various asset classes. This could include mix of stocks, bonds, real estate, commodities like gold, diversify, reducing risk, and allows you to take advantage of different market conditions. Educate yourself. Understanding the basics of investing strategies and how different assets behave will help you make informed decisions. You can start by reading books, attending webinars, or following financial news and resources. Use dollar cost averaging. DCA is a strategy where you can invest in fixed amount of money at regular intervals. This helps you avoid trying to time the market and reduce the impact of market volatility. That was all about why you need to take these steps. I hope it all made sense. Make sure you watch other videos as well. Take this value and let's grow. I'll see you guys in the next video.